Welcome to Breaking News to Trading Moves. You know, imagine paying a 55% markup on a house just so your rival can't move into the neighborhood.
Right. Yeah, that would be a pretty aggressive move.
Well, in the corporate world, that literally just happened.
Mm-hmm.
And to the tune of $1.4 billion, Germany's Henkel is acquiring Nasdaq-listed Olaplex.
Yeah, that is a massive number to wake up to.
It really is. And we have a clear mission for you today. We're going to focus purely on the facts of this headline, and then we'll follow that with a breakdown of the specific winners and losers in the U.S. beauty market based strictly on the reported deal terms.
Exactly, because we're looking at the realities of the market here, the mechanics behind the trades, exactly how a single acquisition alters the landscape for, well, multiple publicly traded companies.
Right, we're keeping it grounded in the actual numbers. So let's lay out the specific details of the transaction first, just so you have the baseline.
Yeah, let's get the math out of the way.
So Henkel is offering 2.06 per share in cash for Olaplex.
Cash. That's a key detail right there.
Totally, an all-cash deal. And that 2.06 represents a 55% premium to Olaplex's prior close.
55%. I mean, that is a substantial markup for an established brand.
It is. And to give you some context on the actual size of the business being acquired, Olaplex generated $423 million in 2025 sales.
Right, so we aren't talking about some small boutique startup. This is a company moving hundreds of millions in product.
Exactly. So why do this? What is Henkel's actual motivation here?
Well, the motivation for Henkel is purely about acquiring an established, highly specialized market presence. They are explicitly aiming to strengthen their premium hair care business.
Meaning they don't want to just sell standard shampoo anymore.
Right. By acquiring Olaplex, they aren't just buying, a line of conditioners in a pretty bottle. They're buying a brand that holds a highly specific science-backed reputation.
Because of the patents, right?
Yes, exactly. It's built on their patented bond-building technology. When a strategic buyer like Henkel decides to allocate $1.4 billion in cash, they do so because trying to replicate that kind of specialized research and development from scratch...
Will it just take forever?
It takes a decade, at least. It consumes vast resources, and honestly, it carries immense execution risk. I mean, you could spend hundreds of millions on marketing of a brand new product and still completely fail to capture the public's attention.
Consumers are fickle.
Very. So buying an established player, one with $423 million in proven recurring sales, is the faster route. It's more expensive, obviously, but it's the most secure way to capture that premium hair care consumer right now.
Think of it like seeing a comparable house in your neighborhood sell for a massive premium. Immediately, you start looking at the surrounding properties to see what they might be worth now.
I love that. That analogy captures the exact mathematical reaction of the market in this scenario.
Because everyone starts doing the math on their own property.
Exactly. But, in the stock market, that appraisal process happens in milliseconds. When that house sells in the real world, the real estate agents update the comparables for homes with a similar floor plan or a similar geographic footprint.
Right.
In the financial markets, the very moment that 55% premium hit the wire, algorithmic trading platforms instantly started scanning the landscape.
Looking for the financial equivalence of that same floor plan.
You got it. They're looking for other companies that share Olaplex's financial characteristics and market positioning.
Which brings us to the actual market reaction. We need to look at the board, starting with the clearest beneficiaries of this announcement.
Let's do it.
The absolute clearest, most direct winner here is obviously Olaplex itself. The ticker is OLPX.
Right, because they are the asset being bought.
Exactly. When a company is being acquired for a massive premium in an all-cash deal, the stock price immediately adjusts to reflect that purchase price. OLPX is the direct winner. But the beneficiaries don't stop there, right? We also have to look at the M&A sympathy names.
We certainly do. This is where we look at companies like Interparfums, ticker IPAR, and ODD Tech, ticker ODD.
IPR and ODD. So these are the surrounding houses in the neighborhood.
Exactly. These are the comparable houses. And the logic here is built heavily on how strategic buyers actually operate behind the scenes.
How so?
Well, strategic buyers, unlike financial buyers or, say, private equity firms, they are looking for companies that plug directly into their existing operational machinery.
Oh, I see. A private equity firm might just buy a company to cut costs and flip it a few years later.
Right. But a strategic buyer like Henkel buys a company because they can push that new product through their already existing global supply chain. They already have the trucks, the warehouse space, the vendor
We
accounts.
just need the product to put on the trucks.
Exactly. The Olaplex deal demonstrates that these strategic buyers are actively willing to pay meaningful premiums for beauty brands that possess strong positioning, intense customer loyalty, and attractive gross margins.
So customer loyalty and attractive margins essentially act as a beacon for these global conglomerates.
A giant flashing neon sign. If a brand has those metrics dialed in, they essentially become a target.
And the trading algorithms recognize that reality instantly.
They do. Traders see the Henkel transaction and immediately deduce that if one major global conglomerate is willing to pay up for those traits, while others might be looking to execute the exact same strategy.
So capital naturally flows into shares of IPAR and ODD.
Yes, it's a sympathy rally. But I want to be clear, it's not based on blind hope. It's driven by quantitative scans for matching customer acquisition costs and margin profiles.
Because the assumption is that the underlying valuation metrics for the entire premium beauty sector have just been upgraded.
Right. Upgraded by Henkel's willingness to pay that 55% premium. If Henkel says a premium beauty customer is worth that much, the market recalculates the value of IPAR and ODD's customers accordingly.
But let me ask you this. Are traders really just screening for the next takeover candidate? Like, is it purely about hunting for buyouts?
It is a primary driver, yes. The market constantly seeks to price in future probabilities.
Okay, that makes sense.
Which brings us to prestige brands that possess takeover optionality. We're talking specifically about ELF Beauty, ticker ELF, and Coty, ticker COTY.
ELF and COTY. What makes them stand out in this scenario?
Well, these companies have incredibly scalable distribution networks and exceptionally strong name recognition. Because they have these structural advantages, they possess substantial room for strategic value to be unlocked.
So if a larger entity were to acquire them, that larger entity could just push those ELF or COTY products through even wider global channels.
Exactly. Instantly magnifying the revenue. And traders know this. Once one beauty asset gets acquired at a premium, investors naturally start screening for the next possible takeover candidate, lifting the valuations of ELF and COTY in the process.
But that scalable distribution strategy we just mentioned relies on one crucial joke point, right? The physical stores.
Oh, absolutely. The retailers are the gatekeepers.
Right. So if a massive conglomerate is about to pump millions into marketing a newly acquired brand, the battleground moves directly to the aisles of the major beauty retailers.
It definitely does.
We're talking about Ulta Beauty, ticker ULTA, and Sally Beauty Holdings, ticker SBH. How do they win in this scenario?
They win through a potential surge in overall category demand.
Walk me through that.
Sure. Consider the mechanics of the acquisition. Henkel just paid a premium for Olaplex. To justify that $1.4 billion purchase price, Henkel will likely invest heavily in growing the Olaplex brand.
They have to make the math work.
Right. That means sprawling marketing campaigns, expanded product lines, and aggressive consumer education. And all of that investment brings more consumer focus to the premium hair care category as a whole.
So when a major manufacturer pours capital into a specific category, it creates a halo effect for the retailer.
Exactly. It drives foot traffic directly to their doors. When consumers see more advertising for premium hair repair treatments, on social media or television, they go to Ulta Beauty or Sally Beauty Holdings to buy them.
Because that's where the products live?
Yes. And even if a customer walks in specifically to look at a newly advertised Olaplex product, the reality of retail psychology takes over.
Right. They never buy just one thing.
Never. They might walk out with 3 other products, a new hairbrush, a styling tool, and some cosmetics.
So for ULTA and SBH, a major manufacturer pouring capital into the category creates a highly positive read-through.
It elevates the average ticket size at the register. And it reinforces the retailer's position as the primary destination for these highly sought-after items.
Okay, but let's look at the other side of the board. A competitor suddenly getting a massive cash-rich owner isn't great news for everyone in this space.
No, it is not.
Logically, if Olaplex is getting stronger, someone else is going to feel the squeeze.
That's the harsh reality of a zero-sum retail environment. This is why prestige beauty incumbents are facing intense pressure right now.
Who are we looking at specifically?
We're looking directly at Estée Lauder, ticker EL, and Coty, ticker COTY.
So wait, COTY again. We'll get back to that. But go on about the incumbents.
Right. These are the established players in the market. Henkel is explicitly buying Olaplex to strengthen its premium hair care business.
Hmm.
Under Henkel, Olaplex is no longer just a standalone brand fighting for its own market share.
Right, it's not fighting alone anymore.
No, it's a better-funded competitor backed by the logistics and capital of a massive global corporation.
And that better-funded competitor goes straight after the exact same resources that EL and COTY rely on.
Exactly.
Think of retail shelf space like a highly contested game of musical chairs. When a heavyweight like Henkel enters the game, the price of keeping a chair goes up for everyone else.
That is a great way to put it. The competition increases dramatically across three specific areas: shelf space, salon relationships, and consumer attention.
Let's talk about the physical shelf space first.
Well, physical retail space is finite. A store only has so many end caps and so much eye-level shelving.
You can't just build a bigger aisle overnight.
Exactly. If Henkel leverages its broader portfolio to negotiate larger displays for Olaplex, that prime real estate has to come from another brand.
Someone gets pushed to the bottom shelf.
Yes. Furthermore, the professional salon channel is absolutely crucial for premium hair care. Salons only carry a limited number of professional lines in their back bars.
Right, they don't have infinite storage room in the back.
Exactly. A well-capitalized Olaplex can offer better wholesale incentives, enhanced training programs, or, more lucrative terms to salon owners.
Which puts direct, tangible pressure on the incumbent brands.
They have to match those offers or risk losing their distribution points entirely. If a stylist is incentivized to recommend Olaplex while a client is in the chair, the incumbent brand loses that highly converting customer interaction.
That makes total sense. But wait, earlier we said ELF, beauty, and oddity tech were potential winners due to sympathy rallies.
Yeah.
Why are they also at risk?
I was wondering when you'd catch that.
Yeah, how can they be on both lists? How can they be winners and losers?
It's a critical reality check about the psychology of trading. We're talking about standalone beauty names without a confirmed deal premium of their own.
Right, no one actually bought them yet.
Exactly. Takeover speculation can absolutely lift stocks initially. The moment the Olaplex news breaks, the algorithms and the momentum traders buy up ELF and ODD based on the hope that they are next in line for a buyout.
But hope isn't a fundamental business metric.
No, it is not.
So the initial spike is driven purely by the excitement of the comparable house selling, rather than anything the company actually did that day.
You're hitting on the core vulnerability there. The initial move is entirely narrative-driven.
Right.
But if days or weeks pass, and investors decide that the Olaplex acquisition is just a one-off deal rather than a broader consolidation trend in the industry, that sympathy move fades.
Because the catalyst never arrived.
Exactly. The traders who bought in purely for the acquisition premium will exit their positions. They aren't long-term believers in the company. They're renting the stock for the buyout catalyst.
That is such a dangerous game for retail traders.
It is. When that speculative capital leaves, those stocks can face mixed or entirely negative reactions. It leaves ELF and ODD vulnerable because their stock prices were inflated by a theoretical event that never materialized.
So they have to suddenly justify their higher valuations based solely on their standalone operational performance.
Without the buffer of takeover speculation propping up the floor.
Wow.
Yeah. If they miss earnings by even a fraction, the drop can be severe because that speculative premium gets wiped out instantly.
It's the danger of trading on a narrative. The narrative pushes the price up, but if the narrative doesn't translate into an actual corporate buyout, the stock price has no structural support at that new, higher level.
Exactly right.
This brings us back to the retailers. Ulta Beauty, ticker ULTA, and Sally Beauty Holdings, ticker SBH. We discussed them as winners because of the category demand and the foot traffic.
We did.
But retail is complex. Why might ULTA and SBH also face downward pressure, despite the earlier point about increased foot traffic? How are they also at risk?
Because of margin risk and channel strategy, it all comes down to leverage.
Leverage. Okay, break that down for me.
Well, when Olaplex was a standalone entity, retailers like ULTA and SBH held considerable negotiating leverage. They controlled the gateway to the consumer.
Because Olaplex needed them more than they needed Olaplex.
Exactly. But a stronger Olaplex under Henkel changes the power dynamic entirely. Henkel's massive, diversified portfolio gives them the power to bundle products. They can walk into a negotiation with a retailer and dictate terms that a smaller brand simply couldn't.
The supplier suddenly becomes much more aggressive with their terms, and the retailer has less room to push back if they want to keep stocking the products their customers are demanding.
That's the exact dynamic. Henkel can dictate stricter pricing power. They might alter promotional activity by enforcing strict minimum advertised price policies.
Right. MAP policies.
Yeah.
So, for example, if a retailer wants to run a holiday discount on Olaplex to drive foot traffic into the store, they usually rely on co-op advertising dollars from the brand to share the cost of that discount.
Usually, yes. But under new management, Henkel might refuse to subsidize that
Oh,
discount.
wow. Which forces the retailer to take the entirety of the margin hit themselves if they still want to offer the promotion to their customers.
Exactly. It eats directly into their profits.
So even if the excitement around a newly supercharged Olaplex brings thousands of more people into Ulta or Sally Beauty, the store doesn't automatically capture the financial upside.
That's the core vulnerability that traders are modeling out right now. Increased revenue does not automatically equal increased profit.
Right, if you're making less per bottle sold.
Exactly. If the supplier commands tighter terms, the retailer works harder and moves more volume just to maintain their existing profit margins.
Are there other channel risks?
Definitely. Additionally, Henkel might change the overall channel strategy entirely. They could decide to pull back from certain brick-and-mortar retailers to focus aggressively on direct-to-consumer sales through their own digital platforms.
Bypassing the stores altogether.
Yes. Or they could demand premium front-of-store placement without offering the historical margin percentages to the retailer.
It's a totally different ballgame.
It is. The broader lesson here is that an acquisition never happens in a vacuum. It alters the leverage between suppliers, retailers, and competitors across the entire supply chain.
Let's concisely recap the main takeaways for you as you navigate this news. The cleanest, most direct winner is Olaplex, ticker OLLPX, because they are the actual target of the cash acquisition.
The most straightforward trade on the board.
Exactly. Next, you have the M&A sympathy names to watch closely. Interperfums, ticker IPAR, Oddity Tech, ticker ODD, and ELF Beauty, ticker ELF. These are the companies traders are looking at as potential future targets.
Remember the risks attached to those sympathy plays.
Right, the narrative fade. And on the flip side, you have the competitive pressure names that must now deal with the better-funded rival or altered supplier dynamics. Those are Estee Lauder, ticker EL, Coty, ticker COTY, Ulta Beauty, ticker ULTA, and Sally Beauty Holdings, ticker SBH.
As you watch these stock movements, ask yourself whether this acquisition is truly the start of a broader consolidation trend in the beauty space or if the Olaplex premium is simply a one-off event.
This is not financial advice or buy or sell recommendations. This is purely the opinion of the author.